It shouldn't need to be said, but I'm going to say it anyway. Team transitory lost. Here we are, years later, still talking about the fact that inflation has not subsided and inflation hasn't come down as fast as they said that it would. So that's where we are at. And of course, this has repercussions. It's a problem for you. It's a problem for Social Security, for your pensions, for everything that people are expecting to be there in the future. Big problems here. So in this video, we're going to talk about inflation. We'll look at the economy, we'll look at stock market, and of course, housing as well. A lot to cover. And I want to begin with this. The Fed can't tame inflation without significantly more hikes that will cause a recession. According to a paper, and by the way, one of the people on that paper is from the former Fed governor, okay? So I just want to show you this because it is really a look at where we are at today, approaching that 5% on the Fed funds rate that we were told that's it, and then immediately they would start to cut interest rates. Well, Jeffrey Gundlach, the bond king, made the case for how that doesn't really seem realistic. Why in the world would they go to increase rates so fast only to then cut them right after? It really doesn't make any sense. And of course, that is true. The Federal Reserve is unlikely to bring inflation down without having to raise interest rates considerably higher, causing a recession, according to the research. We find no instance in which a central bank-induced disinflation occurred without a recession. That's what they found in their study. And so the Federal Reserve is so smart that they know everything, that they're going to be able to do it even though no other central bank has ever done it. Isn't that unusual? Simulations of our baseline model suggest that the Fed will need to tighten policy significantly further to achieve its inflation objective by the end of 2025. Remember, they want to get to an inflation target of 2%. How are they going to get there? Well, they have to bring up interest rates, or we need to see, for another reason, we need to see a huge recession, massive, and that would slow everything down. Well, we'll see what happens. Even assuming stable inflation expectations, our analysts cast doubt on the ability of the Fed to engineer a soft landing in which inflation returns to the 2% target by the end of 2025 without a mild recession. That's what they're expecting. So they got to pull that down. Or, as we've seen, the suggestion has been that they're going to increase their inflation target and basically say, you know what? I think it's not going to be 3%, 2%, it's going to be 3%, or it's going to be 4%. In the case of that mention, I think it was from one of the Fed groups, St. Louis Fed perhaps, they said 2.75% would be where they would expect it to be. So here we are. Just increase the target and you can get there. Isn't that unusual? Here we have the key U.S. inflation measure surges at the fastest rate since June. The Federal Reserve's preferred inflation gauge rose last month at its fastest pace since June, an alarming sign that price pressures remain entrenched in the U.S. economy and could lead to the Fed keeping interest rates well into the year. As a result, the stock market did not do so good. They didn't like that news, of course, because it means that rates will have to remain high. They told us no, they would be cut, but here we are. And what does this mean? Well, of course, you can expect that if the Federal Reserve has to keep rates high, what does that mean to you? What's the takeaway here? Number one, you're going to see the stock market not liking that. There's different reasons for this, but their profits are likely to be hit either because, price pressures on their end, like incoming. But at the same time, if prices are increasing, the consumer can only handle so much. So they're going to get less inward that way. If they're not making as much money, they don't hire. They actually freeze on their hiring altogether. And then you see layoffs. How big those layoffs are depends how long this goes on for. So that's what we're at. That's where we're at. Okay. At the same time, you're going to see much volatility within all the financial markets, including the bond market. We're already seeing that now. Pretty chaotic. We'll talk about that more in a second. And as well as the fact that when you look at real estate right now is in this position where they're hoping rates will come down, but they're not getting that. You leave rates at a certain level for a certain period of time, and it will have a material impact on how many permits there are, how many buildings are built. Of course, the sales are directly affected as well. Inventory starts to build, prices start to fall. As prices start to fall, people go underwater. All of those home flippers start disappearing. All of these things put in place today under the assumption that inflation continues. Like, okay, it can go down, the year-over-year increases, but prices aren't moving down, and we're still increasing in price year over year. Big problems all around. So that's the takeaway for this, okay? We have the warnings of a stock market bubble finally proved too much for the S&P 500. This is referring to the PEG model, which I'll talk about in a second here, okay? The danger, growth is at risk while valuation pressure builds. So the PEG model, as they say here, it was from Peter Lynch. You might know Peter Lynch. Well, the PEG ratio, the market price earnings multiple divided by its forecast growth rate. The higher it is, the more expensive shares are. And right now, it's at about 1.8. 1.8. Okay, so what does that mean? Well, not so good, right? Let me show you this. Stocks look stretched relative to future growth. We haven't seen this level in many instances. 1.8 on that ratio. This chart goes back, it looks like, you know, the 80s or 90s. Haven't seen that before. So even still today, based on this one indicator, there's a million indicators, but based on this, it's only been higher one time. And so that shows us we are in a bubble territory still today. There is no fear in this market. You got to realize that there's talk about, oh, there's so much fear. All of this maybe very temporarily and on a short-term view of it, but there isn't any fear. The markets, they look at this and they say, well, don't worry about it. You know, the Federal Reserve is going to cut interest rates. So let's just get in right now. And that's where that bottom was in October. However, as I said, this could be a near-term bottom. And we don't know what's going to happen, but when you're tightening, you don't want to put all of your cash in. You don't want to go all in. That's unwise. During these periods of time, you might start to pick up a little bit. You might throw down a little bit because you had so much cash on the sidelines, or maybe you had sold some assets before. But you don't want to go all in when they're tightening. That's not wise. And that goes for any asset right now. Some companies, you know, they're ignoring all this. When the Federal Reserve starts to print money, then you go all in. Then you realize that everything's going to be devalued and you want to make sure that you hold on to that value you have. That's when you invest. But we know how the cycle works, and if you're trying to fight against it, do you remember, don't fight the Fed, don't fight the Fed. It works both ways. Okay, here we have the top 5 subcomponent contributors to the US PCE. That's the, this is the Fed's preferred ratio or inflation gauge anyway. So it just breaks it down. Food and beverage purchased for off-premises consumption, food services and accommodations, housing and utilities, and so on. Okay, so you can just look at that and just basically breaks it down. And just showing us that while the prices haven't, you know, they're off their peak in terms of their increases, we are still way, way above the trend we were at before. That's all. Okay, and this is one of many articles I've seen. British growers warn of leek shortage due to challenging weather. I saw one about apples and pears, all kinds of crazy stuff. Salad and onion shortages expose another side of the food crisis. All different types of things are happening, and it's unusual. You know, you're in a developed nation, you expect it. You go to the supermarket, hey, everything's going to be there for me at all times, right? That's not the way it's working. Really isn't the way it's working today. And we see that it's very apparent. What's the next aspect though? What do we have to see? Well, let me show you some factors that will affect everybody. This is referring to the bond market. Bonds are getting beaten down again, and that means that they could do a better job of protecting the rest of your portfolio from getting beaten up. Did you see the video that I did? It only had a few thousand views that I just did maybe 2 days ago, around there. 2-3 days ago, and I talked about if inflation will remain high, then what do I invest in? That was the title of the video. And I talked about this. something called risk parity. Risk parity is essentially the notion that there are going to be tough times. And so your portfolio might be rising during a bull market, and then during these bear markets, it gets pulled down. But you want some of your portfolio to have a means of, still, lifting you up necessarily on, compared to the rest that is doing bad. And sometimes traditional investors, they look to bonds for that reason. And when they're looking really attractive like they are right now, it starts to, you look at stock market, maybe it's going to be okay. Or I look at bonds. If I trust that the government's going to stay ability to print money, basically, they're not going to go bankrupt. Okay, I'll put my money there. That's what's happening. And of course, not one or the other, but where you're deploying capital at the time. So that's what's happening right now with traditional investors. They're looking at it and they're saying, hey, I'd rather put my money in, or at least this capital I have, I'll put it in a bond rather than the stock, because at least I can get 5% on it. Investors have resumed worrying the Federal Reserve will have to crank up interest rates higher and longer to stifle inflation after dismissing such fears a few short weeks ago. Treasuries have lost about 5%. So this is, like, when I say this, you don't get into ETFs and stuff. We're talking about buying the actual bonds themselves, okay? This is real estate, okay, showing us the existing home sales collapsing down to the housing crisis levels. This is just showing us another way to look at it, going back from 99 up until now. Haven't seen anything like this. Pretty extreme on a year-over-year basis. But we're going from one extreme to the other, of course, so it will look like that. This is the S&P 500. It broke down below its 50-day moving average, however, didn't break below either the 200 or the 100. So we're in a very tight situation right now. That's all I'm trying to say. For the stock market, it's really precarious. It has to be able to stay above these averages for a little period to kind of formulate, this is like a foundation, this is stability right at this point, and then it can bounce higher in terms of technical analysis. But with the Federal Reserve not pumping in cash like they were before, it's certainly difficult, so I'll tell you that much. Really quickly, let me show you this. This is the yield curve inversion, specifically the 2-year and the 30-year. What does that mean? Well, wouldn't it be interesting if you were to take out debt for 30 years and you take out debt for or you buy debt that's 30 years out, you buy debt that's, let's just say, in this case, 2 years out. Is that what I said? 2 years. And wouldn't you think that the 30-year would give you a better return than the 2-year? Well, no, not in this case here, because it's called the yield curve inversion, where everything's flipping up on top of its head. I mean, this is just the craziness of the world we live in today. And then, because I love to give you some humor, a mystery buyer wanted an 800 square foot trailer in the Hamptons so badly that they offered a staggering $3.75 million for it. Yes, it's right on the beach. Yes, it has the views right of that beach there. But it's $3.75 million for literally a trailer. Now, it's nice. It's a nice trailer. It's, it's modern and all that. But $3.75 million? What I'm trying to show you here is that some people still have money to burn. We're not in a recession in that case. Like, for some people, they're not in a recession. So for some people, they don't know it's a recession. If they're fully employed, if inflation hasn't hit them very hard, maybe they don't have kids in college, maybe they don't have much food to buy or something. They don't pay energy bills. They don't feel it. But for some people, they feel it real bad. And we're seeing some of those elements today. So that's where we're at. I gave you the takeaways. I gave you a little bit of look at what's happening here over the course of the last little while and what we can expect into this future. If you appreciate that information, then I ask that you hit the thumbs up. Okay, that's all I'm asking. And don't forget to come back tomorrow. You will probably not see these videos in your feed. You got to come back tomorrow. Type in the Money GPS. I'll see you then. Take care.